REITs are today some of the most popular investments among individual investors, and it's pretty simple to understand why. They have historically outperformed most other investments, including the S&P 500, growth stocks, gold, bonds, and even private real estate. And that's despite being safer than most of these investments, providing significant dividend income, inflation protection, as well as diversification benefits. Therefore, it may seem like a no-brainer to include REITs as part of an overall portfolio strategy, but before you rush and buy just any REIT, you need to recognize that this is a vast sector with significant discrepancies from one REIT to another. Just to give you an example, the industrial REIT Prologis was very rewarding to its shareholders over the past 3 years, but during this same time period, its smaller peer Industrial Logistics Properties Trust almost went bankrupt. This shows you that it's very important to be selective when investing in REITs, and in today's video I'm gonna give you 5 tips that I wish I knew before I got started, as it will have saved me a lot of money. Hey everyone, this is Yossi. I'm a CFA charter holder but not a financial advisor, so make sure to do your own research. I run a small investment firm that specializes in REIT investing, and in today's video I'm gonna talk to you about 5 common mistakes that I see a lot of REIT investors make. But before I get into it, could you please do me a huge favor and click the like button? That will really help me a lot to grow this channel. Thank you so much in advance. So the first mistake that investors keep on making is that they put way too much emphasis on the dividend yield, when in reality it really should be just an afterthought. A lot of investors appear to think that a higher dividend yield will result in higher total returns over time, but in reality it has been the opposite in most cases in the REIT sector. Typically, a payout ratio is simply the result of a payout ratio that's not sustainable, too much leverage, troubled assets, conflicts of interest that the REIT market are seeing, and then pricing accordingly into the stock. And in most cases, the total returns of these higher yielding REITs end up being lower than those of lower yielding peers that have more conservative balance sheets, lower payout ratios that allow them to reinvest in growth and own better assets. A great example here that has lost me a lot of money in recent years is a REIT called Medical Properties Trust. This is a very popular REIT among individual investors because it pays a very high dividend yield, but its total returns have been a disaster over the past few years. On the flip side, its lower yielding healthcare peer Welltower has been a very successful investment over the same time period. The point here is that the dividend yield of a REIT really doesn't say much about its future total returns, and Medical Properties Trust is a great example of that. The dividend is really just a capital allocation policy. It has no impact on the assets of the company or its fundamentals, and therefore it really should be just an afterthought. Then the second important thing that you need to know is that a lot of REITs are uninvestable because of significant conflicts of interest. There are today over 200 REITs in the US, and most of them are well managed in the best interest of shareholders. However, there is a minority of them that suffer significant conflicts of interest, and you should avoid them at all costs. This is true for a lot of externally managed REITs that outsource their management to an outside asset management company that then earns fees for taking care of the management of the REIT. The problem here is that the fees will typically be tied to the volume of assets under management, and as a result they will be incentivized to grow the REIT as much as possible, even if it leads to shareholder dilution. A great example of that, in my opinion, is Global Net Lease, which is a REIT that has consistently issued more shares to the market to buy more properties, to grow its management fees, but in the process the shareholders have gotten diluted and suffered very poor total returns. This just shows you that if a REIT is poorly managed, then the rest of the story is irrelevant, and because of that, the first step of my analysis is always to look at the management and potential conflicts of interest. Then the third important lesson here is that cheap can and will get cheaper in many cases. There are a lot of REITs that are priced at extremely low valuations, and a lot of investors will often think that if a REIT is priced at a large discount to its net asset value, then you cannot really lose money. After all, this means that in a worst case scenario, if the REIT needs to be liquidated, then there will be a lot more left over than the current share price of the REIT. But it's not that simple. First of all, net asset values are highly complex calculations that are based on a number of assumptions, and if you make small changes to them, you may get very different results. Therefore, you may think that the REIT is priced at a 50% discount to its net asset value, but if you even slightly adjust the cap rate higher, the discount may close down to just about 20 to 30%, especially if the REIT is highly leveraged. And then secondly, if the situation really gets so bad that the REIT needs to sell all of its assets to liquidate, the net asset value will likely end up being quite a bit lower. That's because the REIT will be pressured to sell all of its assets and buyers will take advantage of that. Then thirdly, the assets may simply drop in value. Today there are a lot of office REITs that are priced at large discounts to the net asset values based on yesterday's cap rates, but if you now expand those cap rate assumptions in valuation models, you will see that the discounts are not nearly as large as it may seem. So don't make the mistake of thinking that a large discount to its net asset value is going to protect you from losses. In reality, cheap can and will often get cheaper over time. Then the fourth important thing that all REIT investors should know is that the best opportunities are typically found in the small cap segment of the REIT sector. Large REITs are scrutinized by far more analysts because most institutional investors cannot invest in small REITs because of their liquidity requirements. As a result, smaller REITs are typically left out to retail investors and smaller institutions like family offices, and because of that, their valuations typically tend to be quite a bit lower than those of large and well-known REITs. Today, the differences in valuations are especially large. I'll put a table on the screen to illustrate that for you. And then on top of that, because there is far less research available on the smaller REITs, there also tends to be more pricing inefficiencies. This means that if you're a smaller investor with a small portfolio, you actually have an advantage relative to the large institutional investors who have to stick to the larger REITs. You, on the other hand, you can buy a lot of these small and lesser known REITs that are priced at much lower valuations. And then the fifth mistake is to only invest in American REITs, when in reality the best opportunities are often found abroad. Today there are REITs in over 30 countries, and many of these foreign markets have a lot more to offer for investors. These foreign REIT markets are still new in many cases, they are far less competitive, they are not covered by as many analysts, and as a result, opportunities are quite abundant. To give you an example here, I think that the American self-storage market is today overbuilt, and valuations for REITs like public storage and extra space storage are a bit too high. However, I believe that the British self-storage market will enjoy far better growth prospects going forward, and yet the leader in the UK is today heavily discounted. So in short, REITs can be highly rewarding investments, but they can also lead to very significant losses, and it all depends on your selection process. If you want to access my entire REIT portfolio, feel free to join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. It will give you access to my entire real money portfolio. If you cancel within the first 14 days, you won't be charged anything. If you decide to stick around beyond that, you're also going to get a discount that we are currently offering for the new year. And then finally, if you could please click the like button, that will really help me a lot to produce this type of content for you. Thank you so much again, and see you at my next one. Bye bye.